Well, everybody's talking about the budget. The budget this year, where everybody was looking forward to a budget, a ray of hope where our country can move forward. From years of going backwards, it's time to move forward. And I will not speak much today because I've got somebody who is the best to talk about economy, budget, Reserve Bank, interest rates, the whole world of economy. Only one man, and there's Jarrod Kerr from Kiwi Bank, Chief Economist at Kiwi Bank. And as I said, without further ado, welcome for coming and giving this information to the audience we cater to. And thank you that you do it every time you come in and you add a lot of value to our clients, our people, and a lot of those who want to understand this in layman terms. So that's why the welcome and thank you. Over to you. Where are we and this big thing called budget, which every financial advisor tells the customer that get your budget right, plan your budget. What is the budget for this year, Chris Luxon's budget or Nicola Willis? What do you think about it? Let's pull it in every direction and see the good, bad and ugly about it. Over to you.
Absolutely. And just to say the same thing, thank you for inviting me back. I love the opportunity to do interviews like this and speak to people that I otherwise wouldn't get in front of. So, no, thank you. I think one thing I'd just say, right off the bat is we think the glass is half full, not empty, and that's not just me. That's Kiwi Bank. We think that there's opportunities out there at the moment that are presenting themselves, and for people who have the ability to think over the medium term and over the long term, there's actually some exciting developments happening. But all we hear about is the negatives right here, right now. We've been through quite a bad recession. It definitely feels like a recession. Businesses are telling us that they're doing it tough and they're worried about the future. So that concerns me. I think my job is to actually get people to lift their heads a little bit and say, well, yeah, it's been really awkward. It's been really bad. But things are turning. They're turning globally. They're turning locally. And this time next year, I think we'll have a growth mindset. People will be a bit more upbeat. But a few things need to happen. On the budget, I think the budget told us everything that we knew. So not only did they deliver on their promises, they delivered on their promises, but we found out that the economy was much weaker than Treasury had previously forecast. Now, we've been saying Treasury's forecasts a little too upbeat, but here's a government that's only just come into power and they're standing in quicksand. They were up to their ankles, now they're up to their knees, and every time they upgrade their numbers, they're worse. So from the government's point of view, corporates, businesses aren't paying as much tax as they thought. They're not earning as much income. GST receipts are weak, so people aren't spending as much. You've got a rising unemployment rate, so fewer people in work, that's fewer people paying taxes, but also more benefits that need to go out the door. So, the government's found itself in a very tough position, trying to deliver on all its promises and do spending that's needed, particularly on infrastructure, and they're hamstrung. Their hands are tied with, how much they can actually get done. So I think, given the circumstances, it was an incredibly tough budget for any government to deliver. They delivered on their promises. We got our tax cuts. That's coming through. We got a bit more spending here and there on health, education. Fine. What disappoints me is the medium-term outlook. We're simply not spending enough on infrastructure for this country. That's what bugs me about the budget, and that's been a common theme for decades, unfortunately. What's going to swing things around, particularly in the property market, are basically three things. So the first is that the government did come through and reduce the bright line test from 10 years to 2 years. 2 years is nothing for an investor, right? It takes you 2 years to get a council consent, right? So 2 years is not an issue. So that's good. And then interest deductibility is coming back in. That's important for investors. So what we've seen in recent years is investors being basically pushed out of the market, but now they're going to return. And they're going to return because rents are rising. They're at 4.7%. That's the fastest pace we've seen since the 90s.
Yeah.
So that's good. House prices are still going sideways, so rental yields are improving. More rental yield, more attractive, investment properties that come up. So that's great. That's the first thing. Second thing is that the supply-demand imbalance is getting worse. So we've imported a lot of people over the last year. Thousands of migrants have come here. They're looking for places. Rents are rising on the back of it. There is a very clear growing shortage of homes. So that underpins the housing market in terms of demand and supply. The key thing, what's going to drive property in 2025 is rate cuts. So we need to be in a position where the Reserve Bank can start cutting rates. And we get there by inflation falling back towards 2%. We forecast that will happen in the second half of the year. If we're right, we might be a little optimistic here, but if we're right, they'll start cutting in November. If we're wrong, they start cutting in February. We will not be wrong on direction. We might be wrong on timing, but not direction. So once they start cutting, that's a decision to go from 5.5% cash rate, say 7% mortgage rates, back to 3%. That's the decision. To take monetary policy from being restrictive to neutral. What is neutral? Well, it's a Goldilocks interest rate that's not hot, not cold, not stimulatory, not restrictive, and they think it's about 3% on the cash rate. So that takes your 7% mortgage rates, into the 5s at a minimum, probably low 5s. That's what people will wake up and be contemplating next year. As that happens, people will become a lot more confident in the housing market itself. A lot of the stresses households face will start to evaporate. So inflation dropping to 2, wages being around 4, that cost of living crisis starts to reverse. Interest that they're paying on homes, all of that stuff gets wound back, and we rebalance and we start growing again.
There's a lot of commentary which I meet people, I go around, and they said the Reserve Bank is not doing the right thing by holding back. They're punishing the country in terms of interest rates. Households are feeling it, the pinch. And I remember our conversation in the last 3 months when we both discussed that, but it's important to have some austerity for us to realize the value of what we have, and so that we don't overinflate our own expenses as well. Are we on the same tag in terms of where Reserve Bank is? Are they doing the right thing still? Or should they have started the rate cuts? Or they should do it sooner than November?
I think they should do it sooner than November. I mean, we're seeing distress out there.
Yeah.
Businesses are clearly hurting, and interest rate hikes have not helped. They've only added to business problems. Same can be said for households. You look at retail spending out there. So what we're spending in shops has contracted 5 out of the last 6 quarters. 8 out of the last 9 quarters on the retail trade. So it's been very weak for a very long time.
True. When sometimes I drive around Burger King and this new Popeye chicken franchise which has opened, I feel there's no inflation or anything because there's too many lines there. People still want to eat fried food. It's just making it on the other side. But what I get from you is that the timing is right now, and Reserve Bank should move. And that's what I'm hearing from a lot of very strong astute big businesses. And they are saying the same thing, so that it's very important to protect the common man. All I'll say is that, what Jarrod is saying, it's coming. It should come sooner, but November or February, this will be there. Well, what does it impact on your strategy is about holding it, taking a last gasp. As we run and we see that the finish line is closer, we run faster. We give our best. So what I'll tell my audience is that the finish line is not far. Yes, we are in austerity, we are in so-called recession. Yes, inflation is coming back. There's positive and negative coming in. But it's important that what they will do, what will happen, it's not what we can control much. But what we can control is listening to what Jarrod has just said and seeing that the finish line is not far, taking the last gasp of savings, of your expenses control, and understanding what really you can save. And if you can have the habit of this last sprint which you do and save money and your expenses are controlled, you'll fly high once the tide changes. Am I right in saying that?
Yeah, I completely agree. A lot of businesses have been saying the same thing, and it's becoming a bit of a saying. It's this kind of white knuckle grip. We've got to fight our way through the next 6 months. And one business owner put it beautifully. He said it's survive until 25.
Wow.
And I think,
very nice.
That's exactly what we're all thinking. Like interest rates will be lowered. They will be cut in 2025.
Yes.
So the pain we're feeling now, we just got to fight our way through it. And then things will start getting better next year. And it's precisely at that point when people lift their heads and gain confidence in things around them, like the property market will have stabilised, we would have seen some price gains. That brings confidence to households and businesses as well. And then that flows through to the broader economy, and we're growing again.
We are. In this budget, what's in for me is every client or everybody asks me, the whole audience or the whole country wants to know, what's in for me? This is a common man's question. What do you think this budget brings in what's in for me?
Well, the first obvious is, how much of a tax cut did you get, right? And you look at the brackets. There's even a calculator that that bangs it out. It's not a lot. It's not a lot at all. It's not going to change the game, but it'll make you feel a little bit better, which is great. There is more spending on health and education and infrastructure, but for me, it's just not enough.
Do you think we need more spending in health?
I think we need more spending on all of the above.
All these above, right?
We've got so many more people than what we thought we'd have, right? So by definition, you have to spend more on a per head basis, So yes, more on all the above. But the biggest thing for me in New Zealand, the thing that just drives me up the wall is our inability to invest in quality infrastructure over the long term. It is what I believe is holding back the productivity in this country. It is what's holding back the housing market, the supply of dwellings. It is what's holding us all back, is that we have failed ourselves, our generation, to invest in everything from roads, rail, ports, whatever it is that we need. We just have not met that demand.
That's a very interesting thing, and I can sense and hear you why you're so frustrated about the whole fact. It's a frustration for everybody.
Yeah.
And this is something, yes, Chris Flaxon has come. Yes, we got national government. Yes, we voted them in. Everything is good. And they will. And there's a ray of hope that they will. But infrastructure spending is the key for everybody. It's not only, that you're putting health and education and the roads and the ports and everything. It's basically creating more jobs as well. And it's creating and getting the right talent in as well. I always take example of doctors because I am very concerned about the health industry. Health sector needs a lot of support, right? And basically, getting in doctors or getting in talent from throughout the world. Selling New Zealand to those, I mean, yes, immigration happened, but I mean, I would, say this, that it could have been done in a better way. A better sort of talent could have been attracted. It could have been staggered as well. Not just what we hear on news about people being cheated, money coming in, and then they have no jobs and they're just becoming more of a, in terms of it's worse for everybody.
Yeah.
And that's what because this government can say it's not my problem, they'll say not my problem.
Yeah.
But it's the country's problem.
Yes.
Right? And the country wants top talent, and we are such a beautiful little place that we do have the world's best talent. If in terms of we put in what environment we live in and where people should be attracted to New Zealand, the whole world would want to come here. But they all want to come here for infrastructure and growth. And that's what I want to put in, and that brings into my next part as well, that infrastructure is a bit delayed, it will come. Let's say they fix the pieces. What is another thing which you would have wanted to see in the budget but was not there?
More around the aging population. This is a big headache for future governments.
True.
So, like most developed economies, you have this aging population. So you've got more and more people aged over 60, which brings to your point on health. Yes. I think that's where it's coming from. But more around how do we fund this going forward? And I think the blind strategy so far is we just import people. So you're importing people in that sort of 20 to 40 age bracket, and they sort of pick up the slack for this bulge that's working its way higher, and that works to an extent. But we are still on a per capita basis, on however you want to look at it, we're going to be spending more and more on health for the rest of our lives as a country, right? So how do we fund that? It's almost political suicide to talk about lifting the retirement age, even though they're doing it in Australia and they've done it around the world. You saw the riots in France when they tried to do it from a year. It is something which I think is inevitable, and it's something that I think brings home the fact that if you're not nearing retirement age, you've got to save more than you think you need to save.
Yes.
Right? KiwiSaver helps. You might be putting 4% aside and getting some matching. You know what? That's not enough. The Australians think you need 12% being put away. Compulsory. And not if you feel like it. Compulsory.
It should be. I believe it should be compulsory for everybody, and 12% what Australia is doing. It's absolutely, if you look at UK and other places as well, for that matter, US as well, they all have to buy insurance. If you don't have insurance, you don't stand a chance. Right? In our country, people who can afford, and that's something which I've always wanted to see, is that there's a lot of affordability in the country. There's a lot of money in the country. Right? And all it could really work out is that if that money of people who are moving to retirement villages, and they have the money, even if 10% is given back to the government or economy, to raise the bar or better health system for other aged care. Because they are at a stage where they can think for everybody. They're not 30s and 40s, we're only thinking about me first. When you're 70 or over, probably 80, you start thinking. And when you're in aged care, right? So I believe, this is not a solution. I'm not the solution provided to the government. But I believe that there has to be a change which has to be brought in. And you're right, I think I'm going to digress again, because it's not about what I think. It's about our discussion today. There was this Reserve Bank's new DTI, which we were hearing for a long time. It's coming. It's actually there now, 1st of July. DTI 6 times and all. Can we have some commentary from you on why DTI and what will it do? And do you agree with DTI?
Look, I think the Reserve Bank rightly wants to have a few more tools. they've got a very blunt instrument. That's an interest rate, right? And we've talked about how it hurts.
Exactly.
Hurts people differently, and it's a very blunt tool. So the LVR restrictions that they brought in, enabled them to say, right, we don't want to fan, too much high risk leverage in the banking system. So that's been in place for a number of years now and has worked, and it definitely works. And when they tighten it, you can see credit conditions changing. You can see the growth in credit changing, particularly when they hit investors particularly hard. They're actually starting to unwind some of those LVR restrictions. Yeah. So they're giving with one hand, but they're taking with the other. The other hand that's coming on is another tool called debt to income ratios, which is obviously the amount of debt you can take on relative to your income, right? It'll have slightly different implications, potentially a little harsher on investors, but it depends on where the settings are. They've said over 6 and over 7 are your high DTIs, right? So we've been given a growth rate that we cannot exceed on that sort of higher than 6, higher than 7 debt to income ratio. What lending are we doing right now is the important bit. We're running below 10%, right, growth in that high DTI space. Our speed limit's 20. So we are miles away from that. We need to see quite a pickup in high DTI lending before we come close to that speed limit. And it's because the housing market's slowed right off, is correcting. So when would it have been used? Had it been in place before, we would have seen these DTI speed limits take effect between 2020 and 22. They would have kicked in, and we wouldn't have seen quite as much leverage being pumped into the system. Yeah. So I think the Reserve Bank is bringing these in, knowing full well that they'll have no impact today, but they will have an impact the next housing boom. Yeah. So don't worry about them today. Yeah. But we know that they're there for the next one. Yes.
So it's basically, DTIs, in terms of when I was reading through them, the brand new properties and the LV exempt properties are still exempt of DTI as well.
I believe so.
Right?
Yeah.
And if that's so, you're right in saying that they're giving from one hand, but they've relaxed on the other side that you now need 30% deposit, not 35% for investment property.
Yeah.
And obviously, there is always ways to skin the cat in terms of, DTI is an important tool. And as you said, it is more for protecting our country from another 21 property market boom.
Yes.
Which is not the wrong thing. It is actually the right thing I was supposed to say, because what I also felt in 21 with the lower interest rates and after COVID, it just felt that people just wanted to make everything tonight. Because I might die tomorrow. Let's make all the money tonight. Well, if you might die tomorrow, the money is not going to do anything anyways.
Yeah.
But when it comes to money, we forget. We feel when it comes to money that we will live forever. And that's the basic thing which we all need to remember, that money is also a tool which has to be utilized to the best of its ability for our advantage. Anything, overuse of anything, even our own self, is disadvantageous.
Yeah.
And that's what money does. But thank you for the DTI part. So as per you, it's the right tool to have. We've got it at the right time, and that'll help us in the future. LV restrictions have calmed down a little bit, so that's better as well.
Yeah.
Now, my favorite question, and you know that, and everybody's thought, we've discussed about leveraging, we've discussed about, hedging, that split your risk, leverage it. In terms of interest rates, if you say rate cuts will come in by November, will it be only 0.25 as a prediction, or will it be higher to start with?
So, good question. We're thinking it'll be just a 0.25 to start with.
Okay.
If they feel they're a little bit behind, they could easily start with a 50. For me, those moves are relevant. For me, it's it's the direction, but where you're going to end up.
Yeah.
Now, on their own forecasts, they are cutting to 3%, right? But it starts at the end of 2025. This is where we disagree. We disagree on the timing.
Yes.
Right? Direction is, I think, almost set in stone. So basically, the decision is to go from 5.5 to 3. That's a big move. That's 250 basis points.
Yeah.
Right? That's a big
move.
Big move. So they might deliver 25 to start or 50, but when you think about the broader scheme of things, doesn't matter if they're getting to 3. And I think, they'll be data dependent, they'll muck around, but they will get to 3. So that's what I've got in my mind when I'm thinking about where interest rates are likely to go in coming years. We might see 10, 15 basis points this year. We might see 50 basis points this year. But next year I think we'll see at least 150, 200 basis points cut.
So we're looking at 4.99 next year.
Potentially at the end of it, yeah.
And we've always talked about the OCR as Reserve Bank, but there's another major factor, cost of funds. What are they doing as of now?
Well, from a bank's point of view, we're fighting for term deposits at the moment, but I'm probably saying that from a Kiwi Bank perspective because we are fast growing, and we're outgrowing the others. So we're getting money out the door, but of course we need to get it in the door at the same time. So we're fighting in that term deposits space quite aggressively, and that's the majority of our funding is in that sort of deposit space. That we do go to wholesale markets. Wholesale markets have been quite volatile. They'll say, there's rate cuts coming, and it's coming as soon as August, and we're going to get 150, in a year's time. They've been very aggressive, and then the Reserve Bank's pushed back, saying that's too much. So now we've got one cut price by the end of the year. We've had this volatility. Now banks trade through that, and we try and fix, rates at the best levels we can, so then we can pass on those wholesale rate declines to customers. And you've seen that's happened in recent weeks. We've seen 15, 20 basis points come off the mortgage rates. That's without a move in the OCR.
Yeah.
Those, if we're right, let's just pretend we are, and that, they're cutting in November, you'll see wholesale rates falling into that decision and then bang on the day. So you'll get some relief along the way, and then you'll get a bang on the day, and then hopefully a bang at each meeting next year as they come through. So I think there's quite a few cuts to come. Timing's difficult, but once they start, I think households and businesses will, have a sigh of relief and a bit of excitement as to where the rates will end up.
Perfect. And Jarrod, overall, as a person who sees charts and figures day in, day out, is New Zealand moving in the right direction? Are we going in the direction where our country is going to get healthier again as an overall economy? Or we are not in the right direction? Like we know the interest rates, OCR, we are in the right direction. But as a country, are we moving in the right direction?
I think so. They're very broadly speaking, you look at the industries that have survived, the industries that are likely to do well. Yeah. It's a story of agriculture. It's a story of a number of our key industries, and I think that they will do well. I'm very proud of what's happened in our tourism space. An area where most people thought it wouldn't recover post COVID. Yeah. Well, that was thrown out the window as soon as we opened the borders. People came back, so that was fantastic. I think, very broadly speaking, our economy is sort of reshuffling. It's re-gearing. It's adapting as well, particularly in technology spaces. We're seeing some really interesting developments, so we are adapting, which will make us stronger. The bits and pieces that we're disappointed, that infrastructure spend, that health problem, that education problem, these are massive problems and embarrassments to have. But I look at us with a future lens, and I see us remaining one of the most attractive destinations. And to remain an attractive destination, you have to have a strong economy, and we will. We will.
So we are in the right direction in terms of as an economy as a whole, and we are in the right direction in terms of interest rates. So good news for everybody who will watch this interview, all the reels, is that we are in the right space of inflation coming down, right space of interest rates moving, cost of funds. So everything is going to get into a positive angle of where you all will have some relief as well. The biggest relief you have today is by listening to this positive interview with Jarrod, and the positivity of that it's just a sprint. The goal post or the finish line is not far. See it, let's say November or worst case February, and brace yourselves, get everything together, save money. You keep your budget ready. You make sure that your infrastructure in the house is not shaken, and you make sure that you run your own house as a proper government, where that's a learning for you as well. I mean, that's what I would say. That's very important, that sometimes there's expenditure we do, we don't need all of that, and if we self-analyze and just sit calmly, we can see a lot of things which we don't need to.
Yeah.
It's sometimes unhealthy eating or unhealthy stuff, but that all can be done when you have yourself in control.
Yeah.
But before, is there anything you would like to bring out which I would have missed for people to know, or anything which you've been speaking about?
Oh, for those who are looking at financial markets.
Yeah.
So New Zealand's stock market, equity market, has underperformed, right? Others around the world, and I find that quite fascinating. The US stock market's really, really performed well, and then there's Australia, and then there's little old New Zealand. It's gone sideways. Again, I think all asset markets will gain confidence into next year. I think all asset markets, will be up rather than down next year. A bit of a blanket statement, but looking at NZX and other share markets around the world, I think once those rate cuts start happening, and they have started happening, like the ECB cut last week, Bank of Canada cut last week, RBA will cut soon, Bank of England, Fed. Where does that leave the RBNZ? Well, they'll naturally be brought in. So those cuts are important, and they're going to fuel a lot of things, a lot of confidence in a lot of areas, and a lot of asset markets will do well next year.
Yeah. So for my common man, what is asset market?
Well, it could be anything. It could be a stock market, so buying shares in a company. It could be a bond market, buying
Bonds.
Buying bonds. And if I'm saying interest rates are going to be falling, the value of a bond goes up when interest rates fall. So there's another market, pretty big market. Anyone who plays in currencies is also a market there. People wanting to buy US dollars or whatever. There's going to be some big changes in that space. So yeah, and then the obvious asset market that we all love in New Zealand is the property one. But yeah.
What about gold and silver? Is it one of my
love it. Yeah.
So is it? I mean, I'm not going to ask because we both are not that. Because a lot of people I have heard telling me, right time to invest in gold and silver.
Yes, I started buying gold heavily in 2007 and 8 because the world was ending, and I thought this is a good play. If we generate inflation, I'll be hedged from that with the gold and silver. And if governments truly start hemorrhaging and taking on way too much debt, then more people will put money into gold than into US dollars. And right, so I was right, but nowhere near as right as I needed to be. I had a 3,000 target in my head, got nowhere near it. Has got close in dollar terms since then, but that pure play of anti-fiat, currency didn't quite play out for me, unfortunately. So I kept it, and I sold a little bit just recently on the recent run up in gold price. But I personally think that I don't care what you invest in. Everyone should just have a little bit of gold as part of your portfolio. It doesn't hurt. And when you most need it is when it's probably most likely to perform for you.
Exactly.
So, yeah.
I mean, there's a lot of noise, and it's out of, question. It's just a question which came in my head. The Ethereums and the Bitcoins and all, I personally believe that that's another trading platform.
Yes.
Nothing different. It's just another trading platform. People are bored of the normal investing in companies. They said, okay, let's Bitcoin, Ethereum, and there are so many coins now.
Yeah.
Is that, does it have legs, or is just another platform which will keep on growing and coming down like other financial markets?
I think the way you put it as being another platform is kind of right. Yeah. So for me, it's another currency. So a lot of people think, Bitcoin's going to bring all the banks down. Really? We like currencies, and you've given us another one. We trade in currencies. You can come to me with Seychelles or gold coins that are 500 years old. Well, I'm pretty sure we'd work a way to take it. It's just a currency, right? We're in the business of lending, right? We could lend you Bitcoin or whatever. Don't worry, I don't care what the currency is. Doesn't bother me in the slightest. What I worry about is Google Bank or Facebook Bank or some proper disruptor coming in and saying we're going to have 0 branches, which are expensive, and we're going to offer mortgages at these rates, and that may happen in this more open banking thing. But
yes,
cryptocurrencies. No, I'm kind of quietly interested, quietly excited to see which ones win and where we end up. But I got a funny feeling that the central banks are creating cryptocurrencies, and they will be the ones that will be probably most adopted, which is an irony, because the whole reason you went for Bitcoin was to stay away from central bank control of a currency. So anyway.
Same thing. I mean, it's a disruptor. I mean, disruption happens, things change, things work around. And, basically it's all about having a balance of investments. In other interest rates, again, a balance. A lot of people ask me, and this is my last question, sorry, when I see you, I just feel like asking all the questions to you today. But in terms of fixed versus floating, I'm seeing a lot of people doing 6 to 12 months. Is that the right strategy to be in that segment?
It seems most of our customers are coming to us with 6 to 12 months, and you can understand it, right? If people are sitting here having a discussion saying could be a cut in November, could be a cut in February, we're not sure on the timing, but this time next year, most people are convinced rates will be lower. So you can understand people not going beyond 12 just on that discussion alone. I can never offer personal advice, so I don't mind telling people what I've done myself. I had a 3-year rate that I put in 2021, rolled off in May, ouch, and I just put it out for a year, because I'm like, by May next year I'm pretty confident.
There will be.
Perfect.
And obviously we don't advise on what to fix or float, because everybody is different and there's no one size fits all strategy. It's your own expenses, your own planning. All we can do is be a guide, and whatever we say, it's not any kind of advice or financial advice. It's just mine and Jarrod's personal takes on what we feel in our discussion. So on that note, thank you very much again for coming in and basically giving a lot of information to a lot of people who look forward to listening to you. And we always get comments, and people call me up and say, where is Jarrod coming? I said, he's coming soon. So they'll be very happy to look forward to listen to all of this. And all I'll say is, I can keep speaking, but I'll say thank you.
Perfect. Thanks for having me.
Thank you.